The winner takes it all. The loser stands and falls. Okay, boys and girls, it's Saturday morning, so it must be coffee with Scruff. But I'm going to combine this coffee with Scruff with an Ask Scruff question. And it's actually what I consider an incredibly important question. Hence why we've rolled it into coffee with Scruff. So let me get my coffee, because we all know Scruffy likes a coffee and he's knackered. The problem with having a 3-story house is when you get a cup of coffee, you're bloody knackered by the time you get up here.
Yes, it's coffee time. Coffee, 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 coffee. Cappuccino.
Okay. So, this one goes out to Gaza. A salute to you, my kid. And I'll kind of take you through it. So when placing a trade, how many points pips will you allow it to run in the wrong direction before you make a decision to kill it? A couple of times I placed a trade and pulled it only to find it's in the right direction and didn't let it run far enough. Okay. There isn't really a pip count. I deal in money as opposed to pips. And the reason why I don't give a monkeys about pips is markets are living, breathing things. They are all different. They have their own little characteristics. They have core beliefs. In other words, the market will move up, the market will move down. But it's the speed of movement which makes them a difference between, say, the DAX and cable. Because if I showed you any chart, the chances are you probably couldn't recognize it. And if I took the time frames off, you definitely wouldn't take. So the pips is irrelevant. So what I have is areas of interest. And that area of interest is X amount of movement. Now, if I was to narrow it down into pips, it's approximately half an ATR. Okay, and if you go through the way, the Scruff, etc., you'll see exactly how that ATR is calculated. But this raises quite a bigger question, because everybody's looking for X marks the spot. And I know this because I did a poll. And I did a poll twice. Now, I did this one, well, or at least I will be when I find it. Have I got it? Yes, here we are. Just pull it into shot for you. And I asked, when you're flipping through YouTube channels, what are you actually looking for? Are you looking for a strategy? Are you looking for an interview, account growth, how to make money? And surprise, surprise, 53%, which is most, and it was higher than that at one point, look for strategy. That's probably something that we need to talk about.
Are you sure?
Then it's interviews. I can kind of go with why interviews is pretty low. Nobody really gives a toss. They're in it for themselves, not what somebody else has done. And that's something that I find is deep ridden into trading. You know, most people are in it for themselves. I do YouTube for a hobby. Trading is my job. So trading, I'm in it for myself. Okay, YouTube, if you follow me, great. And if you don't, well, thanks for clicking on the link. But wish you well in your journey. But if you enjoy it, do hit the subscribe. Makes me do more. That's me being in it for myself.
Good job.
Okay. But then I found only 20% looked at account growth. And the part that I was shocked at was how to make money. See, that's what nobody tells you about on this. See, when you're on YouTube and you're flicking through and you're seeing all these videos that are glossy and they're sort of high profile, what's the end game? So we'll touch on that as well. Now, I said I did 2 polls on this. Now, the people that come into the group that I moderate, and they've been there a while, and trust me, people in here have been for years and they're doing really well. So I am really proud of these guys. And it's kind of why we connect and we get together and speak to each other face to face. I'm one of the few that'll stand in a hotel room, pull a live chart up and tell them what's going on with it. Not many will do that. And it's likewise when you see the channel, you always see me in the moment. I don't believe in rollback charts. It's very easy to build a strategy You know what the outcome is, and that's what we're going to go back to.
They've done studies, 60% of the time, it works every time.
That doesn't make sense.
But I did a poll in here. This one was completely different. They weren't looking for the strategy. Interviews they couldn't give a toss about. Account growth, because we go through account growth all the time. And this goes back to the original question. How many pips? Because pips mean growth. But do they actually make you money? No, not really.
What?
So, with that said, let's get into coffee with Scruff. So we know I work on roughly about half an ATR. It's kind of working on a pivot principle. And the pivot principle is, well, if it's on the upside, there's more buyers. If it's on the downside, it's more sellers sort of thing. And the way I look at it with that, if it's gone through half an ATR, I might be wrong and it's going for the full ATR. So therefore, just get out, because if I'm on a trend day, I'm finished. But every chart and every trade is individual. They are, because the charts are individual. You can look at it and you can, I see it all the time. They'll have a multitude of products running at the same time. And they're flipping from cable to euro to gold to crypto, silver, pound JPY.
Are you serious?
You name it. They're looking at about 10, 12 products at once. And they're jumping from one to the other. Oh, yeah, H4 is pushing down. Oh, my God, look at this. It's pulling back on the 15. Maybe there's a short opportunity. Let's see what the minute chart's doing. It's absolute horse crap. Absolute bollocks. But you're looking for that in the strategy. You're looking to see how they do it. All right? But the question is, do they do it? Do they make money?
Fuck no!
No, they're showing you how to flip round a chart. Now, this is the kicker. Every strategy works. Every single one of them.
I don't know where you get your delusions, laser brain.
The problem is knowing when to use it. That's something what nobody really tells you. They just say, oh yeah, when this moving average cross happens, you go long. Fine. But what do you do after that? What have you done before that? Why was it going long in the first place? You don't know, because you're looking for a mechanical system. A system that is kind of 100% all of the time, and it's almost an ATM that you're going to print money. And then you find that you're not making money. Well, that is 95% of what you see. And if the failure rate is 90%, it's funny how those two numbers are pretty damn close, isn't it?
No way!
Trading is relatively simple if you apply something called common sense. Markets will move up, markets will move down, but they'll also oscillate throughout the day. All right. Now, sometimes you can over leverage an account. It's very easy done, certainly in the prop industry. In the prop industry, you can have £100,000 account, 300, 500, it doesn't really matter. But you'll see them going, oh yes, I'm managing this £300,000 account. So what? Doesn't mean anything. It's fuck up. Your drawdown is the account. So therefore, you're managing what the drawdown is. The rest of it is buying power. I've got a BlackBull account with 2,000 quid in it. I can put huge positions on that if I want to. But I'd be stupid to do that. Now, well, case in point, I'll just show you. Because I did kill a trade off the other day. And I'll explain why I killed it off. So if I pull this down, I trade Bitcoin on this particular account quite a lot. Done 53 quid this morning. Now, these build up. Each month I take, the minute I'm taking it out pretty much every week, take a lump of money out and I put it in a Vanguard. Why do I do that? It's because I don't care what happens to this account. Every week I take X amount out and put it somewhere safe. I put it in my trading slush fund. That means that if this ever goes wrong, I've got money to put back into it. But if I allow a loss to get out of control, not only do I not get paid, I lose the tool that's paying me as well. So stops are not as definitive as what you think they are. A stop has one clear job. One. It's got nothing to do with your trade. And I don't care how many books you read, how many gurus you look. This is my personal opinion. But for me, a stop has nothing to do with the job. Nothing. All it does is protect the account from being lost. Now, your tolerance to that can be, well, I'll take 50% of the account. That's up to you. As long as you're prepared that when it hits that 50%, you're happy with it. If you're not happy with it, why'd you take the trade in the first place?
They made me do it. They bullied me.
We haven't looked at the profit side yet, because the profit, it has its own job. The stop is something that you're happy with that protects the account, period. Now, there are other ways of doing it. Now, today, I've now got an extra 53 quid to play with. Now, I work on daily allowances, and this is driven by the ATR. So, is there a pip count in that? No, not necessarily. So, if I pull this up, I'll kind of show you something from the other day. And we'll just go back the last week or so. Okay. So, all of these profits are adding up. Bing, bang, boo. Killed them here. Just wasn't comfortable with the trade. Just got out. Sacrificed. But I also sacrificed trades at what's called net positive. So I build into it backwards. And if I'm net positive and I've got 50 quid, 20 quid, a fiver, but I've got a couple of red marks, but these sort of paying it off, boof, I'll just kill it out. Bang. Get paid. And I get paid when it hits one of these levels. And if you know how to draw a level properly, you're halfway there. Now comes down. Right. Similar situation here. Bang, bang, bang. Down, down, down. Down, down, down. Down, down. But then I had a bad time. This bit here. But on the run into that, I'd already banked all of this. So that 89 was already clearing off the big loss that I'm about to take. It was already banked money. So my stop pip count was irrelevant. The reason I killed this is because it's Easter weekend. And on a Thursday, it becomes like Friday. And I took the decision, do you know something? I'm net positive about 70 quid. I'm going to kill the trade off, bank the money, cash it in, and have a nice peaceful weekend, because Friday, Good Friday, is like Christmas Day. The market's hardly moved. There's nothing going on. Nobody's interested. I don't want to trade it. So it didn't, right? Then you've got Easter Sunday. That's going to be terrible. Then we've got Easter Monday as well. So even if I go into market, and I often do, I'll be trading very, very small, but I won't be paying a great deal of attention to it. All right. I want to be comfortable. So I won't have a big position in like what I had built up across a couple of days to get paid. So the loss hit me, took 460 out, and then I've just done that again. So across this week is that. So I'm quite happy. I'm really happy with what's gone on. Now, if I flick in sort of out of actually, if I put all history on, I think it might. There we go. So there's loads of withdrawals and everything there. Okay. So we started this because we rolled them into together, 1300, and it's had 1354 profit out of it. And out of that 1354 profit, I've withdrawn 460, 860. So this month, and we're on the 19th, it's paid me 860 already from my initial starting grid. Now, the way I do things is a lot different to people, because I'm not interested in the account growth. I'm interested in making money. And that's why there's a difference between the two. You see, I can have 1,000 quid and it can pay me like 50 quid, 50 quid, 50 quid, 50 quid, 50 quid. All these 50 quids add up. And then I take half of that out for me, which is what you see. And the other half I leave in the account as a buffer zone for one reason. Stop. It allows me to use wider stops because I've already put money into it. Now, yes, you need a bit of experience to do that, and it's a way of building. However, when I look at sort of some of the comments and everything, it's like, oh, show me my statement. You know, can I buy your statement? Why the hell would I sell my personal information? But that raises another question. What I do has nothing to do with you, and what you do has nothing to do with me. You know, it doesn't matter. You should never worry about what somebody else is doing and get frustrated. The only people who do that are normally losing money. And they're losing money because they went looking for a strategy. And the strategy they're looking for doesn't exist.
Kramer, say it isn't so.
Oh, it'd be so.
Common sense exists. Now, I know this video gets smashed to pieces, as every single video I ever do does. But trading is not about strategy. It's got very little to do with strategy. A strategy can be as simple as flicking a coin. I'm buying it, I'm selling it. Right. That's it. Because we deal in the future. None of us knows what the future is. And you can have somebody who, well, let's put it this way. I've sat with Joanne, and she can call the direction as good as anybody. Yet if you ask her how a chart works, she couldn't tell you. What she does is she looks at it and goes, well, I think it's going up. Fine. That opinion is as good as anybody's. But what happens is people try and drill so far into the charts for a search for more information. And they think the more information they have, the better trader they'll be. Where it's actually the other way around. The more information you have, the worse trader you'll become.
Really?
Because you'll have analysis paralysis. And when you get into that, you start second guessing yourself. Then you'll take some small wins and you think you're pretty good. And that win might get a little bit bigger and you think you're pretty good. But then you'll take a huge loss. But you don't understand where that loss came from. And the loss came from your ego. Because you've got it so nailed down in your head, you think you're absolutely correct because the strategy cannot lose. Well, let me wake you up. It can, and it does. Now, I don't have a strategy. I don't believe in them. What I have is a framework. Now, when I come to market, I've got all my key levels in place. I must have my levels. Because now I know I can trade between 2 points that I know have been tested in the past. Okay. I need my fibs on. My fibs reinforce those key levels. So again, I've got a little bit of information. Doesn't tell me direction or anything. Then I look at various things. I look at general direction. That'll give me a clue. I look at for momentum to see if I'm going with or against that general direction. And then I look at strength in the market. Now, if all three of them are running in the same direction, brilliant. We're on to a winner. But I also look at what's called the law of averages through three baskets. A deep basket, a double D basket, and a null basket. And again, I'm looking for alignments and I'm making a common sense decision as to whether or not the price in the next hour is going to go with or against those baskets. If it does, brilliant, I'll hold it. If it's against it, by definition, I'm scalping. This comes back to the original question of how many pips do I let it run against me? I don't. I let it run between levels. So if I'm caught between two levels, that's a trading arena. My stop will be on the other side of it. Now, depending on how big I want this to go, I want a level and a swing point. Now, what if it's 2 zones away? Then I've got to ask a question. Am I prepared to take that trade because of where I'm going to place the stop? Well, if the answer is yes, it has to be worth it. One-on-one, if you like. If I'm putting 50 on the table, I want 50 back. But there's different ways of getting that 50. I'm not expecting to go into market 100% at point of entry. So therefore I stage backwards. That again allows me a bit of a wider stop, because I work on the third entry as the original position, and then that to stop is normally pretty darn tight. But it's a difficult one, because trading it's very individual, guys. It's very individual. And if you're just hunting around looking for free strategies, all you'll ever do is spin wheels. But if you want to make money, talk to a businessman, and they'll talk about something called ROI, return on investment. I'm willing to put X amount on the table to gain X amount back. Your bank account is an ROI. If you put £1,000 into your bank account and they say they're going to give you 5% return, you would think that's amazing. Certainly in this day and age, where an average bank account gives you about 2% return. But in trading, you want to put your £1,000 on the market and think you get 3,000 back. Sometimes it doesn't quite work like that. So you take what the market's willing to give, and that's the levels, because that's where it's going to bounce and it's going to turn. And as long as you're trading the free air, you're okay. You know, if it breaks through the level, then you might not be okay, and you've got to decide to pull the plug if you think you're wrong. And the distance between that entry point and that exit point is a Y factor. It's unknown. So in answer to the original question, I don't have a set of pips, but I do have a monetary amount that I'm willing to take on. So if I look at an account and it's say £1,000, and that stop is going to cost me £100, I have to quickly think in my head, will I pay £100 for this trade? Well, the answer is no. I would find that quite uncomfortable. So how do I combat that? Now, the inexperienced would pull the stop in. They'll leave the position size the same and move the stop further in. Well, that's suicide, because you've now invited the market to take the money off you. Whereas if you'd actually worked out where the stop should be from protection points, level in a swing, that's where it needs to be. A stop has to be where it needs to be. There is no fixed position. So how do you get it to there and make it viable? You half your position size, not half the stop. So now, if you've halved your position size, it's going to cost you 50 quid. So you can go 50 quid against 1,000. It's all right. You know, I'm not very happy about it, but it won't kill the account. Well, if you're aggressive, you go with it. If you're still unsure, you half it again. And it'll cost you 25 quid. Yeah, 25 quid against 1,000. I'm kind of go with that. Fine. You've now agreed to the trade and you're trading at peace. And if you're trading at peace, when you look at the market, you're not going to pull your stops early, because you've already agreed to it. And what you'll find is, if you put it in the right place, swing and a level for protection, you'll find that the bounces that it hits can also give you an opportunity to get out scot-free if you think that you're wrong.
I'd buy that for $1.
So kind of a different copy with Scruff. And I do mean it when I say, well, let's put it this way. If you're coming onto a video and it's all glossy, nice mood lighting, coming in like this, and it's all exciting, and they're jumping from chart to chart to chart, and then they roll the chart back to show you how the strategy works. Well, anybody can be a millionaire doing that, if you know what the outcome is. Just think about it. Are they showing you something, or are they sucking you into something? Who knows? Anyway, nobody ever gets this far into the video anyway, but if you have, I really appreciate it. And if you haven't, well, wherever you left the chart. All I'll say is with YouTube. YouTube can be fun and it can be a great source of information. But the information is only as good as what you digest into it. Likewise, something is only worth what you pay for it. So if you're looking for free strategies, it's worth exactly what you paid for it. Nothing.
If you're good at something, never do it for free.
You want to make money? Apply common sense and look after what you're doing. In other words, if you're over risking something, you're going to blow the account. If you over trade, you're going to blow the account. If you're trying to trade too many assets at the same time, you're definitely going to blow the account. And just as a bit of advice, levels on daily charts, direction on the hourly chart, entry on a 15-minute chart, and then step back to the hourly to get out. That's a simple and easy way to trade, and it'll make you money. It's not exciting. In fact, it's very boring, but it does make money over and over again consistently. And then when it comes to money management, well, I have my ways that you just sort of see. I just build an account up, take the money out, put it in a slush fund, and then build up the account again, take the money out, slush fund, build the account up, put it in a slush fund. And I just constantly rinse and repeat like that. And I'm always trying to bring the leverage down because I don't believe in leverage. Leverage is also the killer of accounts. That's why the prop industry has a big problem. People over leverage constantly and then blame the industry. There's nothing wrong with the industry. The industry is very good if you treat it correctly, but most people don't. Treat it like a casino. Be boring, guys. You make more money. So as always, do what you love and the money will follow. See you on the next one.